Hi friends, in this video we will be talking about profit and loss account. So I have prepared a small video on very important concept that we keep hearing on a daily basis called profit and loss account in financial statements. So what is a profit and loss account? So profit and loss account is something which in our daily life we have. For example, right now I'm sitting. I can have an individual profit and loss account. How much profit I made in the day and how much expenses or maybe costs which I've incurred, and net what will be the thing. So either it will be a profit or a loss. So keeping that in mind, financial corporates, institutions, companies prepare a regular profit and loss account. So what is a profit and loss account? A profit and loss account is basically talking about the operations of business and volume of a company in a given period. Now, for all practical purposes, this is 1 year. Okay. Now, earlier I explained that assets of a company is basically equal to the liabilities plus the capital of the promoter called owner's equity. So if we rewrite this, it will can be rewritten as owner's equity is assets minus liabilities. Now, owner's equity also is nothing but the contributed capital plus retained earnings. That means the profits and the capital, which is the total owner's equity. So what does that mean? Now we can rewrite assets as liabilities plus contributed capital plus retained earnings, which means nothing but revenues minus expenses. So this becomes another way to describe the assets of a company. Okay, now coming to profit and loss, or basically measurement of income, we need to understand few important things. First, profit is nothing but the difference between the revenue and expenses. Now, coming to the principle of measuring income. How do I measure income? There must be some way to do that. The first is that we need to follow accounting principles called realization, accrual, and things of accounting period and matching. These are four important things. Now, I will explain to you each one by one. Now, what do you mean by realization? Realization means that when goods or services which are being produced, it is deemed to accrue or arise in a particular period. So what it means is that, for example, I am producing, let's say, 100 rupees worth of goods, but I am incurring, let's say, 70 rupees of cost. So I cannot have a situation where I can have 100 minus 70 and report 30 as profit unless I have sold those goods in the market. So it is very important to also have these goods sold to report this revenue in the period. Herein comes the principle of realization. Next is called principle of accrual. That means anything which is accruing in a particular period or deemed to accrue in a particular period is called as principle of accrual. Then we talk about accounting period, which again means in a financial year or period that is decided for which we have to calculate profit. And then matching, that means only those expenses that are equal to the revenue for that particular period will be matched and then used in the reporting. Now, what could be the exceptions to the rule? So while I said the first thing about realization of expenses or realization of what you call revenues, the most important thing is that there are two exceptions to this rule. So one is, for example, long dated sale contracts and long rated construction projects. For example, metro rail project, which is a 20-year project. Now I cannot wait for 20 years to allocate that this will be the cost, this will be the revenue. So for each particular year, whatever has been realized cost and realized revenue, I will report that for accounting purpose. So these become certain exceptions to the rule. Okay, Then there are certain other things also, like the revenue, which we will discuss now in detail. Now, what is revenue? Revenue means nothing but the income of an enterprise which is in a particular period. Now, this income can be operating income and non-operating. Now, what is operating? Which is from the operating profits or operating losses, and non-operating means the non-core business, non-operating income. Now, let's come to another thing called measurement of expenses. Now, what do you mean by measurement of expense? So there is a certain cost which is there in a particular period. So that means costs of goods and services which are exchanged. So only those costs which have expired during that period will be treated as expense. Now, what does that mean? I have explained earlier that let's say I have produced goods worth rupees 500 or 1000 rupees, but I have not sold a penny, and I have incurred 300 rupees as cost. I cannot treat that as an expense item for the period because goods have not been sold. So let me take another example. Let's say the cost of goods worth which I have bought from the market and is worth 100 rupees, and I had done some processing, and then I'm selling them uh, for 150 rupees, but I have only sold, let's say, 75 rupees worth of processed goods, and the expense is obviously proportional, which is 50 rupees. Half of it is sold, so expense will be also half. So I will only report 75 minus 50 in this period, that is 25 rupees net, and the remaining cost or goods worth 50 rupees will be shown as an inventory in the balance sheet. So this is very important thing to know. Now coming to other important things like expenses, when we talk, fall in three main categories. First is the expenses which are in this year. Then there are certain expenses which are of previous years, but they become expense of this year because, for example, in this year only those things have been put to use. For example, inventory. So last year you had inventory worth 500 rupees, which I've just shared in the above example, sorry, 50 rupees, which has been unsold. So only when in the year in which it will be sold will that proportionate income be treated, will proportionate, sorry, thing will be treated as cost. Then there are certain things, for example, if I've taken some loan or liability in a particular period and I have to pay regular interest or commitment over a period of time, but that initial liabilities cost which I've incurred can be treated as also expense during that particular year. So I'm just trying to share what I've written down, and it's all extempore. So it's just a basic concept for all of you to understand. So expenses are basically recognized under what circumstances? I would like to put it differently. So expenses in a given period obviously can be recognized as expenses. Number two, indirect expenses can also be treated as expenses during the period, like salaries, rents, insurance premiums, depreciation in the year. And also certain things like loss on account of fire and other things for certain good floods can also be treated expense during a period. Now, what kind of assets can become expenses? Firstly, inventories, as I shared. Number two, there are certain prepaid expenses. For example, I've paid insurance premium in advance, but then obviously the service I'm going to use right now can also be treated as expense. And obviously, long-term assets can also be treated as expense during the particular period. And for example, depreciation on building, furniture and fixtures and all. So that's about it. This was just a basic video to help you understand, because everybody deals with financial things in a day-to-day basis. So this basic layman approach towards things. Kindly note, this is just for education and learning purposes. Thank you very much.